So how's Denver?
It's lively. Let's just leave it at that for now.
It's not hot?
It's getting hot. Yeah.
Yeah.
Thank you so much for such a great presentation earlier.
Well, thanks.
Yeah, we'll see who all join. It sounds like a few other people are chiming in. We'll see how many people join this group.
Dennis, I was very curious to learn more about the royalty product that you guys were providing. And I don't know if you guys have done any white papers on that, or if we'll have time to dig in later on, but I'd love to hear more.
Sure. Well,
yeah.
That.
Great. Hold on. Yeah. Hold on to your ideas, because we'll see how many people join us here, and we'll see whether we get to have a small group discussion or if we have 150 people. Well, we don't know. It's all a big surprise. All right, let's give folks just a couple minutes. Pop on in. Another few seconds and then we'll just get started because it's just a discussion, nothing formal. All right. Well, I'm sure people will keep joining us. So I'm Catherine Ferguson. I'm with the Aspen Institute with the Community Strategies Group. And I'm just going to serve as a monitor as we go. So this is open discussion time for you with Crystal and Dennis, here to speak and tell you more and answer questions. I would suggest if there are things you want to talk about, especially as this group might grow, just use the chat box. Right now I think I can still see most people, but it looks like we have some people we have 12 people who are here right now, so we probably can't quite all see each other. So do use the chat box and I'll help moderate the conversation as needed, and just pay attention to the time. And with that, I'll just turn it back over to Dennis and Crystal in case there's anything else you would like to say as we get started to kick off a conversation. And again, just want to thank you both for sharing the bit that you did, and to all of the folks who are now, all of the many guests and participants who are joining today for taking time, actually, especially for this second hour, to have an informal dialogue on the issues that are really interesting to you and what you want to know more about. So do use that chat box, and I'll do my best to help keep the conversation going. But with that, I'll turn it over to Dennis and Crystal.
Crystal, I think maybe what we could do is start off by talking about the state of our portfolios and just some of the things that we've been trying to do COVID-wise, and I think that then ties back to what some possibilities are in terms of funding support and partnerships that we can enter into, if that makes sense. So
I like that.
Okay, so Northern Initiatives, we have about 265 current loan customers. And so when it appeared like everything was going to shut down in Michigan, which was in early March, we decided that we better get in touch with all of our customers. And so we really blitzed, trying to talk to everyone that we possibly could, and we ended up reaching 98% of our customers, and trying to find the state of where they thought they'd be, particularly with a prolonged shutdown or some other challenge. And so we ended up offering payment deferrals that have ranged from 1 month to 6 months, and small bridge loans, which were intended to try to help cushion the fact that everybody still had expenses, even though they weren't going to be able to generate revenue. And as I said, we've done 2 surveys now of our customers, trying to find out who's gotten PPP, who's gotten idle, um, where they think they stand in terms of their ability to reopen, and what are some of the most pressing issues. And as I said earlier, the most pressing are really two. Will people come back, and under what circumstances? And so restaurants in Michigan are largely going to be at about 50% capacity because of social distancing and other considerations. Their costs are going to go up because of PPE requirements. So those are going to present challenges. And already before, in the early stages, a third were also concerned about cash. So it's pretty rare when a business has put aside 3 months operating capital. I mean, we urge it, but it's a pretty rare thing. So those are all complications that we're going to see come about. So the first big hurdle we'll face is that the first wave of deferrals will come off at the end of June. And then the second wave of deferrals will come off at the end of September. So, what does that mean? Does that mean that we're going to have losses this year of 2% or 25%? At this way, there's no way of telling. All you can do is strategize around what the different issues and options that you may face, and be willing to have open discussions with your partners. And we'll get into what some of those discussions might look like after Crystal talks about her experiences in portfolio.
Thank you, Dennis. So we're a little bit of a different animal, for lack of a better word. We're an intermediary lender. A majority of our portfolio is to native CDFIs, who then therefore within their tribal communities support entrepreneurship, consumer lending, infrastructure development, and homeownership purposes. So in looking at how this really hit Indian country, I have to say I'm incredibly proud of our team. We telecommuted a couple of days anyway, and as a national organization, we're generally all over the United States, but we were able to pivot very, very quickly, both within our lending and our technical assistance provision. So within this, very fortuitously, OWISTA prior to COVID, based on industry demand, was looking at implementing 2 new products within our lending suite. So we developed a line of capital product as well as a working loan capital product. And once we had that accepted by our board and our lending committee, were able to distribute those. But let me go back to the portfolio. So in looking at our portfolio, immediately, OWISTA held conferences within, I'd say, the first 10 days and got a hold of every single portfolio client to really ascertain where they are, what their biggest stress points were. And what we found was a majority of our native CDFIs had already been immediately not only providing the technical assistance, but providing the financial forgiveness that these small businesses would need to survive COVID. So with this, we're seeing massive loan deferrals go out within our constituents' portfolios and really working with these individuals to look at the long haul and recovery. As OWISTA has somewhat of a different, structure within capitalization and lending, it took us a little bit more time to ascertain where our investors would fall within those measures, as we were asking for principal and or interest forgiveness on some of our investments as well, to be able to dilute that down to our clients. So what we've done collectively as an organization, we actually implemented some pretty radical interest and forgiveness payments. So within our entire portfolio, we have provided until December 30th interest forgiveness. So they're not paying us back principal and interest payments for the next 6 months. So we are incurring that loss, obviously, internally. But one thing really innovative, I think, that we're doing as just a native CDFI industry, and looking at the vulnerable state of our economic statuses as rural communities or as native communities, and looking at how we really are going to be able to thrive through this, we're going to rewrite our portfolio. We're going to rewrite our entire portfolio. And we're going to extend out those terms. So I think what CDFIs are really worried about across the nation, and this is over 1,100 organizations. So take out, the portions not only servicing rural communities. Banks are worried about the same thing. So one, positive aspect is we're all in this together, but we're all worried about what a potential portfolio implosion looks like. And the whole premise of CDFIs is helping those marginalized communities that didn't have access to credit and upward mobility measures. We know, and based on our own risk portfolio management, and a lot of that honestly has to do with relationships, respect, and being responsive to what our clients need, we're able to do that. But in order to really look at the long-term sustainability, we're going to help our native CDFIs rewrite their portfolios. We're rewriting ours the beginning of January, so we've provided huge forgiveness and interest payments to really assist our native CDFIs in our tribal communities, and are moving forward in that aspect. So I feel really good about that instance. We normally were sitting at a 3.3% LLR. I've recently raised that to a 10%. That came directly from our net assets. So I mean, that's $1.8 million gone, backed up in this cash reserve. I'd feel much more comfortable if I had 25%, but I don't. That's okay. We're kind of getting to that process. So really what we're looking at in response to COVID, not as this immediate financial crisis, which we all are, but how are we really going to sustain our organizations? And what's particularly, and this is my pulpit, concerning to me in the same regards to Dennis, and looking at how many of these small businesses are going to survive, one thing we need to look at is the intermediary lender servicing 69 certified CDFIs and 30 emerging CDFIs. How many of our organizations are going to make it? And what really concerns me there is, in looking in 1999, we had 2 certified native CDFIs. Now we have over 69. These are still in imperatively impoverished, entrenched communities. And I'm not one to stand on a poverty platform, but poverty is real, and those are systems that we're breaking. As far as I'm concerned, we cannot afford to lose one CDFI, one native CDFI, because it's really going to be our organizations that pull our communities through on a financial and capacity building sense to see the other side.
Mm-hmm. So
let's, I'm sorry.
Thanks to both of you for providing another level of detail. It was hard to get to in the initial presentation. And so I want to make sure that we do open this up. And so you can use the chat box, making note of your questions. We have one initially here that says, Crystal, have you found any interest from your philanthropic funders on providing grant capital to support interest forgiveness on your borrowers? Also, have you seen any specific philanthropic funders that are interested in providing patient capital to support CDFIs growing their LLR funds? And I'm happy to just call on you. We have 16 people in the room, so there's plenty of, so you can all speak for yourselves. I'm just getting us started. But just so we have, everybody has a chance, if you'd like to be called on and ask a question, just make note of it in the chat box.
So I'll answer that briefly. The first question was, do we have philanthropic organizations interested in 2 things? What was the first and second? I'm sorry again.
Yeah, sure. Mariah, do you want to speak for yourself?
Yeah, sure. Thank you. So I'm curious, you talked about providing interest forgiveness for your borrowers as an intermediary loan fund. Have you seen any philanthropic funders that are interested in supporting your ability to further support your borrowers, for one? And then for 2, on an organizational capacity front, have you seen funders that have been interested in providing some, whether it be patient capital or equity capital, to support the increased expense of loan loss reserve funds that are then obviously affecting your net asset ratio, which you did a great job of describing in your earlier presentation?
Those are great questions, and unfortunately, and hopefully this isn't in all of our parts, but my answer is no and no to both of those, but we're working towards it. So, and really switching, I think, philanthropy's measure of what impact looks like. We all have worked in this funding world where we go to the next new initiative that, and that could be a matter of vernacular or not, but really in funding the pure core necessities that we need of CDFIs, which is, it could be guarantees, it could be additional equity, it could be operating capital. those aren't the sexiest things that lenders want to fund. So I've got individuals coming in and saying, let me fund and give guarantee on your COVID related products, and we'll put a guarantee on that. Well, that's great. We've just got out $3 million the last couple of weeks in emergency loan products, but I'm really worried about my $25 million portfolio itself. So can we, switch conversations over? So I think we're getting there. I have seen much more interest, in all honesty, from the philanthropic sector in providing PRIs, whatever their vernacular is, low-cost loans. At this juncture, I used to take money in at 2%. Now I'm only taking money in at 1 or 0. So I'm seeing much more interest in the ability to really just capitalize our funds for the terms that we're looking for, rather than a little bit more innovation on what we're needing. But we have wonderful conversations. I don't mean that to be as a derogatory statement. I think a lot of that is just educating and making them understand the full facet of what a CDFI is and how this affects, different aspects. So we're on that road of discovery and communication, but it's been a hard sell for me, for lack of a better word. Yeah. Dennis?
Well,
Betsy.
It looks. Yeah,
So-
Betsy, it looks like you have a question.
Okay.
No, I was just going to give an example. We were able to get a $100,000 grant from the Kendall Foundation, which is based in the Boston area and interested in regional food systems. And with the express purpose of using that grant money to pay principal and interest payments for the 35 farm loans that we have in our portfolio for the summer. They recognize that the food system is, at least in our region, is really been turned on its head, and there actually are really interesting opportunities for the local and regional food system with the fraying of the national and global food system, but that if you're a small farm and you're trying to deal with all these changes right now and you have to make these payments, it would be very challenging. So that's just an example of a funder and what we've been able to do with that.
And Betsy's with Coastal Enterprises, for those of you especially who are on the phone.
Myself, sorry about that.
No problem.
We actually, one other thing that we did, we had to cancel our annual event, and we had about $40,000 of sponsorships. And we actually, because our Sharia compliant loans are set up with fees instead of interest, we can't use SBA micro money to fund those. And so they weren't able to benefit from the 6 months of principal and interest payments from the SBA. So we asked our sponsors if they'd allow us to use that money to provide the same 6 months principal and interest payments. And they all agreed, which was terrific.
And I would just say that what we've been doing recently is modeling so that we can try to estimate where we were coming out of the Great Recession. So Michigan, that was the lost decade. So it was quite painful for the state in terms of we consistently had the highest unemployment in the country, and then the Great Recession came. And so we're modeling based upon what that experience looked like coming through the Great Recession, which was we had a 12% loss, a 9% loss, and then a 6% loss. So we're looking at the next 5 years and making assumptions about if that's the experience this time, what's that doing to loan loss reserve? And I can tell you what it does is it pushes us up another $1 million that we have to put into loan loss reserve, as well as write-off. So the effect could be not kind to a balance sheet, and certainly not good to the P&L either. So, we're using that model, and now that puts us in a position to really be better able to ask for support. And the other thing that we're doing is, looking sharply at our expenses, and typically we're trying to have 90 days operating support, and now we're going to try to make sure we have 120 days operating support by the time we hit year end. So you know, as I said earlier, there's so much uncertainty about what this year is going to look like. You know, and the best we can do is just constantly stay in touch with our portfolio borrowers, try to offer them. We've now built a tool that is in our customer portal that that customers can then look at if over the next month I'm at 33% of revenue, what do my expenses need to look like to hit break even? If I get to 50%, if I get to 60%. So we're helping to coach them to at least do the best job that they can in understanding, you know, what path they may find themselves up against, and how to prepare their business as best they can to get through this.
Other questions or topics you would like to discuss? There's got to be something, because you intentionally came over to this group and are spending another hour of your time. So something's on your mind. Is there something you're struggling with and you want to bring that to the group too? I mean, I think that's totally fair. What are you working through within your own organizations?
Certainly don't want to monopolize the conversation, but Dennis, I also was really curious to hear more about the royalty product that you had talked about earlier on. You know, you had mentioned in your remarks that PPP, or somebody had mentioned that PPP is not always the best tool for all borrowers. So we did deploy, you know, a little over 9 million in PPP funds, but recognize that that is not the best product for all of our borrowers. And thinking about what are products that can support them so that we're providing as patient capital for our borrowers as we are looking for as an institution.
Well, the thinking was that, you know, we've got about 25% restaurants in our portfolio. And so they're going to, they're in particular, well, we got restaurants and a lot of seasonal businesses because of where we're located. So you got a lot of folks who are going to be challenged either because of conditions or because of spatial awarenesses and other things that are going to limit their ability to generate income. So if we just keep offering loans, you know, all that's doing is adding more cost at some point. Yeah, I mean, you can defer them, but at some point you're offering more cost and you're not recognizing that the challenge that they're going to face is revenue. So the idea of the royalty agreement is that we wouldn't be looking to have any payment happen until they get to 75% of their pre-COVID revenues. And then we start to do some sharing of revenue. And the sharing is going to be calculated toward reducing principal. And so the idea would be that maybe as far as 2 years out, you're going to have a conversion into debt. But for maybe 2 years, what you're doing is you're just being a patient partner. So as they rebuild their revenues and hopefully we get past COVID, that they have a better opportunity to maybe get through this by not really forcing them with other expenses that they can't manage at this time.
I'd be interested to hear if any others have developed sort of, I can't call it post-COVID because COVID's still here, but post the start of COVID financing products. We did a couple weeks ago, after sort of doing some traditional sort of relief and deferral, we put out a loan we're calling a Wicked Reboot loan. We have Wicked Fast loans, and Wicked is a sort of Maine, New England terminology that you may or may not be familiar with. other than the, you know, from the Broadway show and the story and movie. And it's basically, we did it sort of in collaboration with 2 other CDFIs in Maine. And it sort of built off the SBA micro money and the SBA offer to be providing 6 months of interest and principal relief. So these would be new loans, not our current crop of micro loans, but would enable folks to get either a 3 or a 4-year loan at either 3 or 4%, depending on the length. Anyway, it did seem, and up to $30,000 if you're a current business, and up to $15,000 if you're a startup. So just recognizing that with some businesses pivoting or maybe having sort of temporary capital needs, that might be something that's sort of small enough and low enough costs that folks would find it helpful, but not something that would really saddle folks with high cost debt. So that's just something that we did. And as I said, we did it sort of in collaboration with 2 other CDFIs that have slightly different names and slightly different terms, but all building on the SBA micro money. I'd love to hear if any others of you have seen a need in the community in addition to Dennis and the royalty one, which, as he knows, I've been quite interested in also. That seems to potentially respond to the needs that you're seeing among small businesses in your regions.
Well, this is Dan Wheat from the Fremont Area Community Foundation. And in addition to the funds that Dennis had referred to earlier on that we provided Northern Initiatives, we're working right now with a credit union that we're hoping to have an agreement very soon that we can announce affordable loan options for small business, both for-profit and nonprofit. And we're hoping that it's going to be a low fixed rate. It's going to be a flexible term, initial deferral of payments from 90 days to 6 months. And hopefully we will be able to leverage some capital to be able to get some businesses back on their feet and recover. We're planning to do some internal underwriting prior to sending an applicant to the credit union. So we'll have some sense of the viability of the business prior to making a recommendation to them to loan them money. So that's in the works. I don't know that it's something that's going to solve everybody's problems. They're going to need to have some sense of ability to recover, and certainly that's the hope of this program, that we can find the ones who can recover and give them a leg up. So that's kind of the thing that we're in the heat of right now, of getting an agreement, memorandum of understanding signed for be able to move forward with that.
You know, another example, this one involved the state of Michigan, but they announced on April 14th that they were going to do a $2 million 1% loan to Northern Initiatives. And so they announced it at 5 p.m. and overnight we got 754 leads on our through our website requesting $52 million. Which is just an example of, you know, Bonnie Geddes was talking about that their community got 30,000 out of $1 million, but who knows what the requests were. But it's just it's crazy, just what the capital need is and how many people are just absolutely looking for anything to try to salvage their business, and B, even to communicate with them and say no, or to say we can't support you at this time, or we can't possibly look at your application till June 15th. We have people who are just so happy that someone is communicating with them, because there are two things people don't do well. They don't do well being isolated, and they don't do well with uncertainty, and that's what we've all been thrown into. And so the CDFI world being engaged in something that's high touch, even if the touch isn't always what people want to hear, is just so important at this time. And then what we've tried to do with the product is, on the 2 million, we're just doing liquid FICO scores, because we know people's collateral has been hurt. We know that their P&L has been hurt. So if we just focus on a liquid FICO score and rethink some of our underwriting, everybody is challenged right now because not too many people are producing revenue. And so it's a challenge back to us as to how do you think about underwriting in a world which is upside down from we pride ourselves on not being a bank and focusing on character and cash flow, but there's no cash flow. So now it comes down to character and liquid FICO scores, and we'll just see how it all plays out. But the demand is insane.
I see a couple of questions in the queue. So Mark is
asking,
do we have any idea on how the $1 billion from US that's been set aside for CDFIs will be distributed? As far as I know, the answer is still no. We've been keeping up on that. Betsy, you may know more. I'm not sure. Do you?
I think this is meaning the 10 billion, which is for the PPP.
Oh, I'm sorry. I'm sorry.
It's to administer PPP loans, I believe. Right. And I should note, we're actually not doing that. We were not initially eligible. And we also have a lot of community banks in Maine, and they've done quite a good job at getting the job done. So we haven't been making PPP loans, but if others of you have, you're in a better place to comment.
We haven't either.
Anyone who wants to jump in who has been?
We've been doing, we did twice the amount of our annual lending last year in PPP loans in the past 2 months, and about the same size of our total portfolio prior, at year end of 2019. So I would say, I'm curious, Mark, if you're in reference to the funds that are being put aside by the Fed, like are CDFIs accessing the Federal Reserve's dollars to lend PPP? Because in regards to that, all of our funds were raised. Actually, the example that Anthony Chang gave earlier, he was directly referencing Mountain Vidworks and the work that we were doing. So Dogwood Health Trust came in with $9 million. We did $350,000 from our own equity pool. And we had a private a private venture firm come in. Originally, they had interest in putting in another $5 million in, but we ended up saying, hey, this is outside of our capacity. We'll take $200,000, but probably won't do more than that. We had to find someone to charter us as a CDFI to be able to get access to the Fed capital. We finally did find a charter, which was Self-Help Credit Union. And we've decided at this time to not take any Fed dollars, just because kind of in response to Betsy's question, we've brought online 3 or 4 new other emergency loan fund product or loan products, and have decided to give PPP a rest for right now before we can, we're focusing on ensuring that our borrowers are able to really reach full forgiveness before we start a whole nother large tranche of PPP lending. Mm-hmm. So I don't know, but I hope that other folks are accessing Fed dollars if they need it.
The House passed a bill last week and the Senate's taking it up, I think today, which would put in more flexibility for small businesses, which would be big. So what we're doing is we're going back through our portfolio again, finding out who hasn't applied for PPP and maybe why they haven't applied, and we may start doing some PPP loans with our own existing portfolio.
So we can stay on this topic, but I'm gonna throw another question into the mix, which is a spin on one that was asked before. Specifically, question is about the extent to which philanthropy is supporting your ability to bring on additional capacity. Given that, Dennis, as you're saying, just massive increases. You give some numbers of the number of applicants you've gotten in just 24 hours. Related, do you have the ability to bring on additional capacity given social distancing requirements? And then are you hesitant in any way to bring on that new capacity since it might be quite short term? So that's all 3 questions in one. And we'll leave it to you to answer however suits.
I can start with that. In our regard, our current grant funders actually have been quite wonderful to work with, in that current deliverables that we have within our grant structures, generally they're longer term, 2 to 3 years. Majority of our funders have allowed us to turn that into operational funds. And with that, meet major deliverables that we have to, but doesn't necessarily go outside or stretch our bandwidth on what we're looking at now. So while that wasn't a direct investment, that actually really helped my program's operations have a little bit of breathing room in this regard. We are massively fundraising, and I'm sure all of you are, for additional operational funds to meet those exact needs. One thing that I think is interesting, or I can just say from our perspective, social distancing, and what does that one-on-one capacity building look like? For us, one of our biggest challenges really has been in broadband access and accessibility. So as I indicated at WISTA, we were very fortunate that we pivoted very quickly and were able to, honestly, we had to reassess, modify, and directly implement a new training and technical assistance program for our operations based on COVID within about a 2-week time. So we've now been doing a predominant amount of that via webinars. We have a WISTA COVID webinar series, and that ranges from anything from initially, how do I use Zoom? What are all of these different platforms I can use to get a hold of my clients, to we're looking at, how do I really modify a loan, or I need to look at my organizational budget. And so it can go in many different measures. They in turn are also doing a lot of their capacity building online, if that's a viability. We haven't seen our in tribal communities as yet. And I think it's important to note kind of the difference there. And rural communities obviously, of course, have so many similarities. But aside from Navajo Nation, and I don't mean to downgrade that whatsoever, but medically, COVID hasn't hit reservations yet. So, and if and when they do on a larger extent, what you're going to find is we're not going to have the capacity to handle it, period, on a medical sense. On my reservation, our hospital has 6 hospital beds and 1 ventilator for 17,000 people. What's that going to look like, right? So, most of our communities are still shut down and staying at home. So a lot of the capacity building we're doing is online, is literally calling individuals up, and we're not seeing a lot of face-to-face contact. When that happens, we're very lucky, and I could use 5 more program officers. So we're able to handle, not necessarily as well as we should, but the larger capacity building needs based on, what's flowing up from the industry. But on regards to this being a short-term fix and we need additional capital just to CDFIs, one thing, and this is my opinion, but rural communities tend to be outside of major, economic footprints, hence why our organizations exist and, have been thriving. It's going to take rural communities from this juncture, in my point of view, a good 3 to 5 years to get back to whatever that normal is. So in looking at the continued capacity building that we're going to need as an industry, let alone as industries representing rural communities, I don't think that this is really going to be a short-term fix. We're going to have to evolve on what those needs are, but we're in for a long haul of a good decade, I think, to try to get our communities back to where we hope they can be and thrive at, and to be able to thrive in whatever sense that is, in the measures as we maneuver this financial and pandemic on a global level.
We've always operated under the assumption that that the thing that's going to cause someone to start a business is because they see someone else successful and making money, and so that is honestly a big worry, because these family-owned small businesses are really the salt of their community. They're the differentiator, the thing that makes a place interesting, and if we can't get most of them through, then it does set a challenge for the future in terms of who's going to follow, I think. So that's a big concern. We were fortunate that we started building a customer platform that is an online platform. We started building it in 2013, and now it's fairly sophisticated. It's got over 100 resources, 21 videos, 7 financial calculators, and it's all organized around money marketing and management. And so we've been using a practice of blended learning, encouraging our customers to use the resources to learn terms and definitions, so that then the coaching time can be spent on strategies and tactics. And that work has really been important through this last 70 days, where you can't go visit customers, and therefore, trying to be in contact and proactive, to try to help them think about what they're going to do. And so now we've also built a whole suite of other resources that are COVID related to keep them updated on what some of the new requirements are going to be for reopening businesses in Michigan, and what kind of experiences they're going to have, as well as how to use PPP, what's idle look like, and the opportunities associated with any of those things. So that side of our capacity has actually been really good. The loan side, which is where you get worried about the bottlenecks, is that that we've done 2/3 as many loans through the end of May as we've ever done in 1 year. So, and on top of that, then we've done 70% of our portfolios had change in terms. So people have just been doing extraordinary work. And so when I say that we had 12%, 9%, 6% coming out of the Great Recession, what gives us some confidence is that we've been far more proactive this time around, and just started with a mantra: we're going to get everybody through this, and are using the tools and resources, and as we need, we'll start calling on our partners to also join us in this effort, or more of our partners to join us in this effort. But everybody's just really humping to get our customers to a point where we put them in the best position to succeed. And we hope that that's going to prove to be the case.
I want to make sure those of you who haven't spoken, or if you have questions, so Alyssa, Dave, Lisa, Stephanie, if pipe in if you'd like to. Of course, you don't have to, but I want to give you the chance.
I don't have questions. I'm just listening and learning. I'm replacing Dennis when he retires later this month.
I'm new to the philanthropic world, so I'm also trying to challenge myself with content that I am not familiar with. So I'm taking it all in.
Great. Thanks for making the time.
Well, we've got about 10 minutes left. I'm just curious, and going back to our slides and what we were indicating philanthropy can do right now, and really trying to lean in all different regards, looking particularly at CDFIs. We had 5 recommendations. Just curious, just with our group here, what entices you? What do you think, wouldn't work collectively for the field or your organization? So obviously we're asking them to provide flexible lending capital, and that's based on relationships and interests. So that's kind of, that's what we're all trying to do at this juncture in time, and get as much, funding as we can, longest terms, lower interest rate. Create new lending pools, or increase the size of existing lending pools within rural America. I thought that was an interesting idea. Again, a matter of fundraising, being able to increase our loan loss reserves, that's going to help us leverage funds and increase our solvency, being able to fund for that. I think that can tend to scare, if you're not financially minded, a lot of investors out. Like, you want me to invest in what could be a loss? Why is that good? You're having losses, or, so there comes kind of the education in that regard. PRIs, obviously, that's another vernacular. It can be an MRI, PRI. I work with so many different, we all do. And sometimes they're just called a loan, or you want to call it this or that. But the 3 that I found challenging for myself were really pushing foundations to start using their endowment funds in a different measure, and being able to set aside percentages of those to receive the impact that they want in whatever region it could be. I mean, they can pick a pot of some injustice, and CDFIs can pretty much fill that wherever we are. So I think really seeing money move, or how big money can move, that could be interesting. I love the idea of loan pools, but in all honesty, in our experience, a lot of that comes down to trust. And who is running this? What does that look like? So that needs to be really defined. But I've shown success in this, just in regards to, I'm always battling against Indian countries, a risky bet. Well, we've revolved $77 million in our history and had 1 low default. So, next story, let's look at this. And we were able to put together for the first time a $10 million pool for native CDFIs. That was a 4-year process that took to get done. And it was actually extraordinary in the mixed capital stack. We had private individuals, we had foundations, banks, corporations. So just in looking at where we think we need to be, what we think are low-hanging fruits, to me the low-hanging fruits would be, obviously we need capital and MRIs, but does any one of those other 3 ideas really coalesce with what you're thinking, where you may be going new within capitalization strategies, or more so ways maybe we can continue these conversations to leverage upon our own relationships and strengths as an industry and representing rural country, and seeing how to make that work?
I have one observation, which is not a true answer to that question, but it is, before moving to Maine, now, believe it or not, 17 years ago, I worked in philanthropy at the Rockefeller Foundation. And in the sort of early days of that foundation's work in what was then program and mission related investing. And more recently here in Maine, I've been on the board of and the investment committee of a Maine foundation. And I think the challenge and the opportunity is, I think, if there is ever a time for foundations to step forward and to make more PRIs and MRIs and consider investing a portion, a small portion, but a real portion of their endowment in the places that they care about, now is the time. I'd say the barrier is that if the funder hasn't already started thinking about this and already started sort of educating their board and having staff who are familiar with sort of the basic principles of investing and have that expertise, it's really hard to get them from 0 to 60. And I think one way to help is if there is one funder that has gone through that thinking, that can be a convener and bring other folks along and say, you know, let's share what we've learned, and is sort of interested in being a bit of a convener and a catalyst. I think that may help bridge from that challenge to that opportunity.
That's a great observation, and I really like that, Betsy. I think once we have kind of stewards in certain regards, whether that's on a foundation or whether that could be, you know, on different aspects, individuals with endowment portfolios, if you have that one organization that leads everybody in. I'll give an example just on another note. One of our wonderful partners, Northwest Area Foundation, they serve an 8-state region. They've really been a catalyst for CDFIs, and particularly supporting Native CDFIs. So when I have a social investor that's, you know, wanting to do PRIs for the first time and I don't have time, they have been my conduit. And Carla Miller, she's about to retire soon, loves me or hates me at the same time. I'm like, talk to Carla. And she has run these organizations a good 20 on how we do this as a foundation, what this looks like for you. And through that, we've opened up tens of millions of dollars. And I think the same thing with the endowment portfolio. I briefly indicated, and this is the first time this has ever happened on behalf of OISTA, so this is kind of our first rodeo. We had been working with Ceres Trust, and they're predominantly, you know, work in agriculture, but never had done anything with their endowment portfolio. And we just received their first investment, and it's smaller, $275,000, but yeah, that's really good. But it's after doing, you know, this longer dance. So maybe individuals we can think of to do that, to say, we didn't really know what we're doing, but in 3 months we got it done and we understand more now. That could be a really good war cry, for lack of a better word, to get more individuals on to show how it works, how it can work. And sometimes in these levels, it's easier if boards talk to each other than we're talking to boards, or, you know, our funding world can be so insular in that regard that that's a great idea. I like that, Betsy. I'm writing it down. I don't know what we can do with it, but we'll do something.
You know, I think, you know, our stay-at-home order ended yesterday. So now people are kind of feeling more optimistic, but we're going to live with this for the next year, 18 months, 24 months. So it's not just a sprint to get capital now. We're going to need capital consistently to keep flowing to support these initiatives, and it can come from lots of different places, and it can be small amounts, because I think what we're going to experience is that we're going to need to do a lot of small bridge loans in support of just keeping businesses going from point A to point B. And sometimes we're not going to know what point B looks like, because if, you know, there's spikes in infection rates again, point B may be months out again. So, you know, if the objective is to try to get as many of these small businesses through this as we can, it's going to take a lot of capital. And that really means a lot of groups that aren't funding today stepping in and funding and supporting, as well as, you know, building a suite of additional federal policies and programs that can support this initiative, these initiatives too.
Yeah. So we have just a couple of minutes left, and there's one other question here. Mark has asked if anyone has a sample community foundation PRI that they would be able to share. And if that doesn't, if there's not an answer, go ahead.
Or a promissory note and loan agreement, or a story, or what are we specifically looking for?
Yeah, Mark, what are you specifically looking for?
Something like a 10-year type term, low interest kind of thing.
So if Dan's still on, maybe he could send you a copy of the ones that his community foundation does.
Okay.
Yeah,
I was going to say to you, Dennis, congratulations on retirement. Best wishes there. The group that I'm working with got started thanks to your some of your efforts and learning, teaching us 12 years ago. So thank you.
Thank you.
Yeah, and
All
Mark,
right.
I'm happy to send you some sample documents if we can get together in terms of email address or that kind of thing. So.
Okay.
Yeah, and if there's broader interest, I know we can also help. The community strategies group can help to facilitate sharing with a broader group of folks. Dan,
No, I'd love to see some of those terms. We've been in conversations with our community foundation for, I don't know, 5 or 6 years, and it's been very slow. But I think kind of towards additionally what Dennis was talking about is looking at people that you wouldn't have initially thought at all to be funders. And one example that I'd love for us to lift up is that we, although as a CDFI, our bread and butter is doing lending, we had similar to Michigan, Western North Carolina is extremely driven by tourism, and our Tourism Development Authority recognized, or the Asheville specific Tourism Development Authority recognized that if all the small businesses closed, there wouldn't be that sought after ecosystem that would draw the tourists here. So they reached out to the General Assembly and had $5 million out of their tourism product development fund be able to be reallocated towards a grant pool for small businesses. They then reached out to us as a CDFI that had strong relationships with small businesses and with kind of underwriting small businesses to administer that $5 million loan fund to be grants up to $50,000 to businesses in the tourism sector, specifically around reopening costs. So providing a buffer of grant capital that would enable them to be able to get through this period and reopen. If you would have asked me last year if I thought we would get a $5 million grant fund out of the TDA, I would have said very unlikely. But now is the time to be reaching out to folks that are deep-pocketed, that are deeply invested in the business culture as well, and make some magic happen. The other group that's really, we're at time.
Oh, I was gonna say we're just at time. I don't want to cut you off, but I want to just acknowledge that because there are probably going to be other people who need to go. But this has really been a great discussion. And again, you're welcome to stay on, but I also want to be respectful of time. And if you need to go now, that's also perfectly fine. And just want to say again, thanks to all of you for being here and for speaking. And with that, I will turn it back to all of you to continue talking just as long as you want. But we'll consider this formally over.
Thank you, Katie. The only last thing I'll mention before I probably need to head off too is that our local municipalities have actually really stepped up as well, which I was very surprised to see due to the significant decrease in their revenue. But we have had 7 communities come together in doing program-related investments for bridge loans in their specific rural counties, which have been small loans, $10,000, 6 months of no payments, and at a 5.5% interest rate for a 36-month term following. So really interesting partners that were slow-moving prior, moving much quicker now during this time period.
Great.
Good to see you all. Thank you very much. I learned a lot and really appreciate everybody's time and questions.
See you, Betsy.
Thank you so
Bye-bye.
much. Take care.
Bye.
Thank you so much.
Dennis, it was good to meet you and present with you. I hope you have a wonderful day, wonderful week, and you're doing amazing work. I wish, and I'm glad you're retiring, and I'm glad that you've got your number 2 coming up here, but I wish we could have worked more together in your history. But I hear wonderful things, and it was so nice to learn more about your organization. Just keep up the good work and enjoy your life as you should. So that sounds wonderful.
Crystal.
Go ahead.
Oh, I'm sorry to interrupt. Crystal, I don't know if you remember me. You were in the 4th Valley Fellowship.
I remember you from Valley, and and you were like a space holder at Valley or a previous Valley, and then I see you all the time at SBC too, or I just started SBC. But yeah, so I'm recognizing your face, and we've had interactions, but kind of just barely touched upon each other. So
I would love to connect at some point and talk more. So
that would be wonderful. I will, or via Dennis, or Dennis, maybe if you just forward something over, I'm just figuring how to get our emails to each other real quick. I can put it on this message possibly. But that would be good. I would be more than happy. So there's my email.
Perfect. All right. I'll send you an email.
Okay.
Great.
I see you all over too. So just wanted to pop in and say hi real quick.
Yeah. Thanks so much to both of you. You did so much prep, and also now your name is ringing a bell. The announcement that you are taking over. But you, Dennis and Crystal, you did a great job, and I appreciate
you made
the
it
amount
really
of time you put into this, though.
Yeah. Thank you for all of your background prep, because really easy.
I'll pass that on.
Okay.
Give me no credit, but I will definitely pass it along. All right. Thank you. Take care. Bye.